Hi there, it's Friday the 19th of October 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB. Let's get started. It looks like the OECD is making some progress in regard to digital taxation. That's the word from Pascal Saint-Amand during this week's OECD Tax Talks webcast. He identified the July 2018 meeting of the Task Force on the Digital Economy as significant. At that meeting, countries put forward various ideas or suggestions, and he mentioned three in particular. The first is a focus on data and user participation. This topic is confined to certain highly digitized business models. Countries which are pursuing this first idea believe that there is no need for any wide-ranging change to the international tax rules. It would be limited to these certain highly digitized business models where user contribution is a key element of value creation. The UK is an advocate of this idea. The second idea involves a broader approach to the allocation of taxing rights, which would take market jurisdictions more into account. This second idea is broad-based. It's not limited to highly digitized business models. Pascal said this: "I think everybody will recognize the US here, saying, we're not sure that there is a real necessity to address this, but if you think that there is a need to address the tax challenges of the digitalization of the economy, then it should be a broader approach." And the third idea involves a minimum tax concept. This idea originates from the introduction of GILTI in the US tax reform, but it has recently been raised by both France and Germany. The task force will further discuss these proposals at its next meeting on the 4th and 5th of December. And then there will be, in Pascal's words, probably some form of recommendation, hopefully a sense of direction identified by the task force and put forward to the BEPS inclusive framework for consideration at its January meeting. And maybe at that meeting, the inclusive framework will identify a program of work or a sense of direction or an agreement on a solution to be further explored technically. And hopefully, again Pascal's words, the OECD will then be able to deliver something more concrete with some form of agreement to the G20 in 2019, possibly at the G20 Finance Ministers meeting on the 8th and 9th of June. Interestingly, the second of these three ideas, the broader approach to allocating taxing rights, is described in the discussion paper which the Australian government released earlier this month. I mentioned this discussion paper in ITB on the 5th of October. The discussion paper says this: "Some of the features that the OECD observed are common to highly digitalised businesses can also be observed in other businesses, including businesses that rely heavily on intangibles, for example, patents, trademarks, and brand names, and businesses that have scale without mass, that is, high sales volumes with a relatively small capital investment in a country. In this context, some commentators are advocating for reform that would apply more broadly, rather than only to highly digitalised businesses. One alternative reform option that would extend beyond highly digitalised businesses and user-created value could involve a focus on intangibles. A possible change might be to view the country where consumers of a particular good or service are located as the source country for returns to marketing intangibles, such as trademarks and brand names. This would provide a basis for allocating greater taxing rights over returns from marketing intangibles to the country where the relevant consumers are located. Advocates for this option consider that the value of marketing intangibles is inherently linked to the market in which sales take place, potentially meaning that the market country is the source of value for the marketing intangible. In addition, often the market country's laws protect the value of such intangibles. Arguably, a change of this kind may be more compelling in relation to the value derived from marketing intangibles than value derived from patents or copyrights, as the value of patents or copyrights may be able to be more closely linked with the place where an invention was made or a work was created. Even though that would be a significant change from the status quo, you can see in that quotation from the discussion paper the clear attempt to place that change into the clothing of value creation, which is the post-BEPS transfer pricing mantra, which seems to have replaced functions, assets, and risks. But maybe the emperor of value creation has no clothes. That's the theme of a recent article by Mindy Hersfeld. She writes, "The OECD BEPS project's principle of taxing profits where value is created illustrates the nonsensical results arising from basing tax solutions on incoherent doctrines. And this, Western countries and multinational taxpayers that ignore developing country arguments and instead rely on claims assuming that allocation of profits must be based on pseudoscientific principles of transfer pricing, miss the larger point. Allocation of profits among nations is mostly political, and economics merely provides a gloss over a political tug-of-war." Let me quickly run through some other developments from the OECD and the UN. The OECD has published the latest batch of peer review ratings on tax transparency and exchange of information on request. 2 jurisdictions, Bahrain and Singapore, received an overall rating of compliant. The other 5 jurisdictions, Austria, Aruba, Brazil, St Kitts and Nevis, and the UK, were rated as largely compliant. For a copy of the 7 peer reviews, please go to our website or app. If you missed this week's OECD Tax Talks webcast, well, the most interesting topic was digital taxation, which I've just gone through. If you do want to watch the video replay, please go to our website or app for the relevant link. And the UN has released an interesting report on foreign direct investment, FDI. In the first half of 2018, global FDI fell by 41%. And the major cause? Large repatriations by US parent companies of accumulated foreign earnings from their affiliates abroad following the US tax reform. If you'd like to read this report, it's only 6 pages. Please go to our website or app. Now for the developments in Asia Pacific. In Australia, the tax authorities have released an updated version of their 2017 guidance on offshore marketing and procurement hubs. The major change involves the addition of a new Schedule 2, which deals with offshore non-core procurement hub arrangements. A non-core procurement hub is defined to mean a procurement hub which supplies goods or services which support the operations of a business, but which are not converted into a finished item or resold. For example, office equipment, advertising, travel, and professional services. Excluded from this definition is a procurement hub which supplies goods or services which are required to perform the core operations of a business. For example, heavy equipment and fuel used in mining operations. A non-core procurement hub will be classified as low risk if the hub profit does not exceed a 25% markup on hub costs. For a copy of the updated guidance, please go to our website or app. In Hong Kong, the region's chief executive identified a number of tax changes in her recent 2018 policy address. Her focus is on the maritime services sector. Specific measures include tax incentives for ship leasing companies and tax incentives to promote the development of marine insurance. She also announced the introduction of a new limited partnership regime. For a copy of Carrie Lam's address, please go to our website or app. In India, the Delhi Income Tax Appellate Tribunal has reached an interesting conclusion in a case concerning Article 7.3. The relevant treaty is the India-Mauritius Treaty. Article 7.3 of that treaty says this: in determining the profits of a PE, there shall be allowed as deductions expenses which are incurred for the purposes of the business of the PE, including executive and general administrative expenses so incurred, whether in the state in which the PE is situated or elsewhere, which of course is very similar to Article 7.3 in the 2008 OECD Model Treaty, and it's also very similar to the first sentence of Article 7.3 in the 2017 UN Model Treaty. In this particular case, the Indian PE of a Mauritius resident company paid employee salaries but did not withhold tax at source from the salary payments. Under the Indian domestic tax law, the failure to withhold tax means that a deduction for the salaries is disallowed. The technical issue in the case is whether that domestic tax law rule is prohibited by Article 7.3. The tribunal compared the wording of Article 7.3 in the India-Mauritius Treaty with corresponding provisions in other treaties, including Article 7.3 in the India-UAE Treaty, which is in the same form as Article 7.3 in the India-Mauritius Treaty, except that it adds this extra phrase at the end: in accordance with the provisions of and subject to the limitations of the tax laws of that state. The tribunal then said, well, there's no such extra phrase in Article 7.3 in the India-Mauritius Treaty, and therefore the parties must have intended that that provision would not be subject to the limitations of the domestic tax law. And accordingly, the tribunal held that the employee's salaries should be deductible for the PE, despite the failure to withhold tax. Of course, the view expressed by the tribunal is inconsistent with both the OECD commentary and the UN commentary on Article 7.3. The OECD commentary says this: Article 7.3 only determines which expenses should be attributed to the PE for purposes of determining the profits attributable to that PE. It does not deal with the issue of whether those expenses once attributed, are deductible when computing the taxable income of the PE, since the conditions for the deductibility of expenses are a matter to be determined by domestic law. If you would like to obtain a copy of this tribunal decision, please go to our website or app. In Japan, the government has announced that the standard rate of consumption tax, which is the name for Japan's VAT, will finally be increased from 8% to 10% effective the 1st of October 2019. This 2 percentage point increase was originally scheduled for October 2015, but has been deferred twice already. In Taiwan, the government is proposing to amend the rules concerning free trade zones. There are two important proposed changes. Firstly, the permitted activities will be limited to preparatory or auxiliary activities, which means that simple processing, which is currently permitted, will be excluded. And secondly, qualified foreign companies will be fully exempt from corporate income tax on sales made to Taiwanese customers. Currently, there's a partial exemption on such sales. In Thailand, the government has announced the repeal of several existing tax incentive programs and their replacement by a single International Business Centre (IBC) regime. This move is in response to BEPS Action 5 on harmful tax practices. The repealed regimes are Regional Operating Headquarters (ROH) 1 and 2, International Headquarters (IHQ), Treasury Centre (TC), and International Trading Centre (ITC). For companies which have a current incentive under one of these regimes, the incentive will remain valid until its term expires, with the exception of ROH 1, which will cease at the end of 2020. And now for the developments in Europe. In Denmark, the National Tax Tribunal has decided two interesting transfer pricing cases, both in favour of the taxpayer. In the first case, a Danish subsidiary within a multinational group acted as a full-fledged buy-sell distributor. It made continuous operating losses over a 4-year period. Importantly, most of its trading transactions were with unrelated parties. The tax authorities benchmarked its negative EBIT against a set of European distributors, where the EBIT margin was between 1.9% and 4.0%. The tax authorities then made a TP adjustment by including in the subsidiary's income a notional service fee for providing the group with a local presence in Denmark. The tribunal rejected the TP adjustment on the basis that the facts in this case don't fall within the circumstances described in paragraphs 1.64 and 1.65 of the 2010 OECD Transfer Pricing Guidelines, and thus an intragroup service transaction cannot be deemed. In the second case, a Danish subsidiary within a multinational group operated as a full-fledged manufacturer in Denmark. The manufacturing process did not require any significant intangibles. The Danish subsidiary did not have any significant client relationships. Its sales were price-driven. Its industry had excess production capacity, and it was not a party to any long-term contracts. Due to continuous losses, the subsidiary closed its business. Despite all those facts, the Danish tax authorities made a transfer pricing adjustment on the basis that the group derived a benefit from the closure and that arm's-length parties would have agreed on compensation. As you would expect, This was rejected by the tribunal. And now to the European Court of Justice, which has decided an important VAT case in favour of the taxpayer. That taxpayer is Ryanair Limited. It launched a takeover bid for the Irish airline Aer Lingus. Ryanair's intention was that after the successful acquisition, it would provide management services to Aer Lingus. Those management services would be taxable VAT supplies. Prior to making the bid, Ryanair was not a taxable person for VAT purposes. Unfortunately for Ryanair, the bid was not successful. Prior to and during the course of the bid, Ryanair incurred VAT on consulting services. The issue in this case is whether Ryanair's intention to eventually provide taxable VAT supplies in the form of the proposed management services to Aer Lingus is sufficient to cause Ryanair to be classed as a taxable person at the time it incurred the VAT on the consulting fees, and whether, as a consequence, Ryanair is entitled to input tax credits for the full amount of that VAT. The court answered yes to both of these questions. Ryanair's future intention to provide taxable VAT supplies caused it to be a taxable person when it incurred the VAT on the consulting fees, and it is entitled to an input tax credit for the full amount of that VAT. If you would like to obtain a copy of this decision, please go to our website or app. Well, you can't say that Germany is not well prepared. The German government has released a draft bill which is designed to protect German taxpayers from the potential negative tax effects of Brexit. If the UK does leave the EU as scheduled on the 29th of March 2019, and if it is a so-called hard Brexit, which means no transition period and no withdrawal agreement, the UK will immediately be considered to be a country outside the EU. That would mean that some German tax provisions which apply only to EU resident taxpayers will cease to apply. The bill is designed to avoid or at least delay or soften that adverse impact. Well, Unilever's decision to not move its headquarters to the Netherlands under a single entity structure has caused or allowed the government to make some significant changes to its Tax Plan 2019, which was announced only last month. In my view, the big news is about tax rates. Firstly, 15%. The existing 15% dividend withholding tax will be retained and unchanged. And secondly, corporate income tax rates. These are currently 20% for taxable income up to €200,000 and 25% for taxable income above that amount. The 25% rate will continue in 2019. The government now plans for the rates to be significantly lower in 2021. 15% for taxable income up to €200,000 and 20.5% for taxable income above that amount. The government's announcement does not indicate what the rates will be in 2020. And in Spain, the government has released its draft 2019 budget. Here are the items that caught my eye. The 3% digital services tax, which I mentioned in last week's ITB, is included. The participation exemption for foreign dividends will be reduced from 100% to 95%. 2 minimum corporate income taxes will be introduced. 15% for groups with annual revenue of at least €20 million and 18% for specified financial and hydrocarbon companies. and the regular corporate income tax rate will be reduced from 25% to 23% for companies with annual revenue below 1 million euros. Now to Africa. In South Africa, the tax authorities have issued updated guidance on the MAP process. For a copy of this guidance, please go to our website or app. And also in South Africa, an inquiry panel appointed by the President has issued an interim report recommending that the suspended head of the tax authorities be dismissed for his reckless mismanagement of the agency. For a copy of the interim report, please go to our website or app. And in Tunisia, the 2019 Finance Bill has been introduced into Parliament. I noted a few points. There's no change in the standard corporate income tax rate, 25%. However, a reduced rate of 13.5% will apply to a range of industries, from manufacturing of aircraft, ships, medical equipment, textiles and footwear, to call centres and international trading companies. A deduction is to be allowed for amounts provided to recapitalise hotels and resorts, subject to a cap of 25% of taxable profits. And transfer pricing documentation requirements have been introduced. Now to the Middle East and Central Asia. In Israel, a government committee has proposed that public investors be allowed to invest in infrastructure projects through publicly traded funds, which would be similar to REITs. The proposal is that the funds would be traded on the Tel Aviv Stock Exchange, and that the funds would generally be tax exempt if they distribute 90% of their profits each year. It's also proposed that tax deferral be given to existing infrastructure investors who transfer their assets to a fund in exchange for newly issued shares. The committee has asked for public comments by the 15th of November. For a copy of the statement issued by the Israel Securities Authority, please go to our website or app. And now to the Americas. In the US, the Treasury Department has released its list of future regulatory projects. And not surprisingly, it's full of projects from the US tax reform legislation, which I call 115-97. For a copy of the list, please go to our website or app. And speaking of regulations, a public hearing on the proposed regulations for the transition tax under Section 965 will be held on this coming Monday, the 22nd of October. And remember the Altera case, which concerns the 2003 US cost-sharing regulations? Earlier this year, by a 2-to-1 majority, the Court of Appeals for the Ninth Circuit allowed the government's appeal against a 15-0 decision for the taxpayer in the US tax court. But unfortunately, one of the Court of Appeals judges in the majority died before the judgment was given. A new judge was appointed, the 2-to-1 majority decision was annulled, and the appeal is being reheard. And that rehearing started this week. The key question is whether the treatment of stock-based compensation in the 2003 cost-sharing regs is valid. There's a lot of money at stake in this case and in similar disputes involving other companies. And now for this week's treaty developments. We've had 2 treaties signed and 1 treaty enter into force. In addition, the UK government has released the MLI synthesised text of 2 of its treaties, the Serbia-UK Treaty and the Slovenia-UK Treaty. These 2 documents show how the 2 bilateral treaties would look if the operative MLI provisions were actually included in the treaties. Importantly, for each of the 2 treaties, the Serbian and Slovenian governments respectively have agreed to the MLI synthesised text. Get ready for a lot more of this in the future. If you would like to see a copy of these 2 documents, please go to our website or app. And finally, in Chile, the tax authorities have issued guidance which indicates that the MFN clauses in 4 of Chile's treaties have been triggered. The interest articles in the Chile-China Treaty and the Chile-Ecuador Treaty are impacted, as well as the interest and royalties articles in the Chile-Austria Treaty and the Chile-Spain Treaty. All of this has been caused by the entry into force of the Chile-Japan Treaty. For a copy of the guidance, please go to our website or app. Well, that's the way it is this Friday, the 19th of October 2018. I'm Steve Towers. Have a great weekend.